Hey everyone, and welcome to This Explainer. I'm going to be your whiteboard coach today, guiding you through what is basically the ultimate revision masterclass for IGCSE Accounting 0452. And we aren't just aiming to pass here, we are specifically targeting that A-star grade. So if you want to completely master incomplete records profit calculation, you are absolutely in the right place. We're going to break down everything, from the brand new 2026 syllabus rules all the way to the exact step-by-step strategies that actually secure maximum marks. So grab your notes, get comfortable, and let's go.
We have got a packed agenda for this session. We'll be hitting 1. Core concepts and terminology. 2. Step-by-step technical execution. 3. Ratio interpretation and evaluation. And finally, 4. Crucial examiner insights.
All right, let's kick things off with Section 1, focusing on core concepts and the updated 2026 syllabus rules.
Okay, listen up, because Cambridge is super strict about this. They absolutely demand modern terminology if you want full marks. You know those older terms you might see floating around in old past papers? Toss them out. You literally need to use the phrase irrecoverable debts with 100% accuracy now. If you use anything else, it immediately signals to the examiner that you just aren't up to speed with the 2026 standards, and we definitely don't want that. It's the exact same story with the owner's claim on the business. If an exam question uses the command word state and asks you for this value, you must flawlessly apply the term owner's equity. Now, this actually ties directly back to the business entity concept, the golden rule that the business and the owner are strictly separate entities. Consistently demonstrating that you understand this separation is exactly what elevates an average exam response straight up to an A-star.
And really, the foundation of literally everything we do in this subject is the accounting equation. Assets equals liabilities plus equity. It's like the law of gravity for accountants. The duality of every single transaction in incomplete records relies completely on this balance. If this equation breaks down anywhere in your workings, I guarantee your logical flow is going to break down right along with it.
Also, we can't forget the prudence principle. Basically, never overstate your profits and never understate your losses. Violating this mathematically skews your whole reality. You really need to make sure you're super comfortable applying key terms like accrued, prepaid, realization, and consistency to multi-layered, complex scenarios. Why? Because in the real world, banks and tax authorities rely entirely on that absolute financial integrity. Moving right along to Section 2, step-by-step technical execution, and, most importantly, securing your method marks.
Okay, take a deep breath for this one because it is a massive relief for exam day. Please don't panic if your final balance is slightly off. When a question hits you with the command word calculate for some complex adjustments like depreciation or inventory, the examiners actually award method marks as long as your logical flow is visible. So show literally all of your math, and you can still secure the credit even if the final number isn't perfect. Think of your procedural flow as a very strict roadmap. You always start by identifying the correct source document, something like an invoice or a bank statement. That feeds directly into your books of prime entry, which then populates your T accounts and ultimately, if you follow the map, lands you at a perfectly accurate trial balance. It's all connected. Now, zooming in on phase 3 of that map, the trusty T account remains the absolute core of the double entry system. You have to master the art of balancing here. Knowing exactly where to place your brought down, or B/D, and your carried down, or C/D balances is completely non-negotiable. That is exactly where the double entry magic happens. Oh, and watch out for this massive red flag. When asked to distinguish between or calculate discounts, students constantly trip themselves up by confusing trade discounts with cash discounts. Miscalculating those percentages will totally ruin your math all the way down the line. You have to keep them distinctly separate in your head to protect the integrity of your final financial statements. All right, let's dive into Section 3, Ratio Interpretation and Evaluation, which is all about hitting those AO3 evaluation marks. We are going to do a little interactive practice right now. I literally want you to pause this explainer in a second. Look at this scenario on the screen. If an exam question asks you to evaluate exactly why a business's current ratio fell sharply from 2.5 to 1 all the way down to 1.1 to 1, what would you write? Pause the playback, try to think of 3 specific real-world reasons, and then hit play when you're ready. Okay, welcome back. How did you do? To hit those high-level evaluation marks, you really needed to look for practical causes. For instance, did the business overpurchase inventory that's just sitting there? Are trade payables settling way too slowly? Or maybe cash reserves were suddenly depleted by a massive piece of capital expenditure?
Identifying those exact triggers is exactly what the examiner is hunting for when they ask you to evaluate. Now, inter-firm comparison is another really tricky area, mostly because differing accounting policies make surface-level comparisons almost impossible. It's like comparing apples to oranges. If business A uses the straight-line method for depreciation and business B uses the reducing balance method, you simply cannot compare their profitability side by side without mathematically adjusting for those different policies first. And this naturally leads us to evaluating the true quality of a profit. I always say, think of profit like a hidden iceberg. You have to look below the surface at the non-financial factors, things like staff morale, physical location, and market reputation. Sure, they aren't captured anywhere in the ledgers, but they are the actual drivers of long-term sustainability and your return on capital employed. That's the ultimate measure of how efficiently a company uses its capital to generate that profit. Finally, we've reached Section 4, crucial examiner insights straight from the 2024 and 2025 reports. Let's see what the graders are actually saying. So, directly from the examiner's desk, a really frequent and highly penalized error is failing to distinguish between revenue items and capital items. Getting this wrong completely distorts your final profit calculation. It's a fundamental error, and honestly, it will cost you heavily on exam day. And here is a direct, word-for-word piece of advice. Write this on a sticky note and stick it to your mirror. Seriously. Students often lose marks through poor handwriting in ledger accounts. This will literally cost you your grade, regardless of how much of an accounting genius you might be. If the examiner cannot read your logical flow, they physically cannot award you those vital method marks we talked about earlier. So keep it clean. As we wrap up this session, I want to leave you with this final strategy. Mastering the numbers, maintaining pristine T accounts, and memorizing that 2026 terminology, that is only step 1. When you step into that exam hall, the real test is proving to the examiner that you understand the living, breathing business operating behind those numbers. Always analyze the true quality of the profit, meticulously show your workings, and go secure that A star. Good luck with your revision. You've got this.